Our final speaker in this morning's sessions on the intersection of exploration and capital markets is Nikki Adshead-Bell. Yeah. And she demands attention. Nikki is a geologist from Australia. She's worked in both corporate world with both juniors and seniors, then pivoted to become a sell-side mining analyst, then an investment banker, followed by moving to the buy side and leading a fund manager analyst team, and then to top it off, became a CEO and successfully sold a junior mining company producer. She has now been focusing on her consulting business, Cupola Advisors, and sits on a number of boards. It truly is an honor to have Nikki here. And for those of you who haven't heard her speak before, you're in for a treat. So please join me in welcoming Nikki in her talk, Creating and Financing a Junior Mining Company. Exploration.
Lise, you should have said I was crap. That's why everyone would have low expectations. It's very weird to see myself with hair. I'd forgotten that was the photograph that we used. So here we go. Thank you very much for having me here today. I have to say that this is my first time at the Yukon at this conference, and it's been wonderful to see the community spirit, the enthusiasm, the presence of government. So I would say from a perspective of being around the world, visiting loads of conferences, this one has some very unique qualities, so keep it up. So I have a platform, and my slides aren't working, so I don't have a platform. I'm stealing my own thunder. Oh, here we go. So I have a platform, and obviously I'm here to speak today about juniors, but those of you that have heard me speak before, this is now my policy. Every time that I give a presentation, I talk about the biggest challenge that our industry faces is reputation. So those of us that interact with people who don't work in mining realize how negatively mining is seen around the world. And my sister, who's a cultural anthropologist, she's an academic, she hangs around other cultural anthropologists, so not necessarily geared towards being positive about the industry, but she has been somewhat corrupted by her mining-focused family. I think she said it best. She said you can choose to be a vegan, but you cannot choose not to be associated with the products of mining. And so this is a call out to all of you to ensure as you go through your daily life to be supportive about our industry and talk about it, because the average person just simply doesn't know where their stuff comes from. And I bring up this chart because I think it's fascinating. I think we've all bought into this negative optics about the sector, that we are the biggest polluters. We're simply not. And what this figure shows is that non-ferrous metal mining contributes 0.7% of global greenhouse gas emissions. Greenhouse gas emissions from residential buildings contribute approximately 10.9%. And we don't have people around the world demanding that we no longer live in houses. So just to put into context where we sit as an industry. So getting back to the topic at hand. It's not going forward. Oh, it is going forward. So when Lisa asked me to speak, she saw me talk about some things at another conference, and it was really about how to create, she asked me to talk about how do you create a junior mining company in a very, very, very challenging world. And one thing all of us as geologists, I'm sure there's probably mostly geologists in the room, at university you don't get taught the business side of it. And I think that's a very, very big lack, because at the end of the day, this sector only exists because of capital flow and money, i.e. we all need money to continue our business. And so I actually think maybe a more appropriate title is How to Build the Perfect or Near Perfect Mining Company. Nothing in this world is perfection, but it's good to try and aim for it. So essentially what we want to have is less of this in our business and more of this. So we live in a cyclical industry. I think we all understand that. Everyone sitting in this room has probably experienced the ups and downs of at least one cycle, if not multiple cycles, as I have. And so you need to understand that. You need to understand that commodities behave cyclically and that investors and companies behave in very, very, very predictable ways, depending on where you are in that cycle. And where you are in the cycle dictates your ability to raise capital. It dictates your ability to control and manage your business. And so it's very, very important. All of us in this room, whether you're focused on gold, lithium, copper, PGMs, whatever the case may be, is to understand where do you sit in the context of the commodity cycle. So just to run through, I suppose, a view of the commodity cycle, and this is a concept that's been adapted from an Australian fund, Lying Mining Selection, and they call it their mining clock. And I think it's a fantastic mechanism to try and be as objective as you can be, about where we sit in the cycle, and then adjust your behaviour accordingly in terms of how you manage your business. So obviously at the beginning of a bear market, I think we know what that looks like. Bankruptcies, everybody is very, very upset. We see asset sales at bargain basement prices. Commodity prices are generally in free fall. We see dilutive financings just to keep the lights on. And we're probably seeing a little bit of that in the junior sector at the moment, where we're seeing death by 1,000 cut financings, $500,000, $1 million, $2 million. And that amount of money does nothing to structurally change your business. All it does is keep the lights on, and allows you to continue to exist as a public company. As the cycle, the bear market starts to stabilise, commodity prices start to stabilise, what we tend to see is capital conservation, and investors are demanding that all high-risk behaviour or all non-core expenditure is shut. That's when exploration geos get fired. They always are getting fired around this at this point in time, and that's when everybody is focused on ensuring that you have a strong balance sheet. Now, this is where the smart investors buy. This is a sign that you're at the bottom, and this is when the smart investors buy. As the commodity cycle continues, prices start to rise, we start to see low-risk M&A, and by low-risk M&A, I mean like combining with like. And so you see producers acquiring producers, and we've seen that in a number of instances, for example, copper and gold over the last 5-6 years. As prices continue to rise, capital becomes more available, the bankers start knocking, they start telling you they can raise money, and with an increase in capital availability, that capital gets spent. And that capital gets spent in more high-risk behaviour, which is exploration. So theoretically, more capital, more exploration, you start to see discoveries, people start getting enthusiastic, that generates more interest in the sector, you start to see IPOs, you see more capital available, you see capital starting to rush into the sector. And the sign at the top, and this is the one thing you always must keep in your mind, because I'd argue we've seen some of this behaviour in the lithium, in lithium, is high-risk M&A explodes, capital is plentiful, and the dumb money comes in. That's when you see generalists entering in mass into a sector, and you see sort of unusual structural financing. So we're seeing the car industry starting to finance lithium. All of those things are normally signs that you're closer to the top at the bottom, and this is when the smart money sells. So moving on to companies and how I look at a company. Number one, cycle. That's critical. Where you are in the cycle matters, because that determines how you should run your business in being able to create long-term value per share for the owners of your business. So I feel like Mike and Neil stole my thunder here on the people versus project. My position is people. If you don't have the right people, your ability to create value is materially negatively impacted. And by people, I mean not just strong technical people, people that understand how the business side of the business works, so people that have got a background in capital markets that can protect you from the evil bankers, which don't really care what happens, they just want to collect a fee. If you're in another country, it's local expertise. So here in the Yukon, I think you'd be pretty shocked, for example, if an Australian company came in and had no people from the Yukon in their board or in their management team, because they don't understand the culture, they don't understand the permitting regime, they don't understand how it works. And so on the people side, we commonly see maybe an Anglophone approach in foreign countries. And often management teams, when things go wrong, they never blame themselves. They always blame the other. It's the country, it's this or that. And often when you delve into failures, it's not having the appropriate people in the appropriate positions that understand how that local jurisdiction actually works. And good people create enormous value with mediocre projects, and bad people destroy value with good projects. Now, of course, the project is paramount, and on the project quality, it's really about geology. You cannot change the rocks. You can massage everything else. You can improve engineering, you can refine your MET, you can improve your social relations, you can develop better government relations, but you cannot change the rocks. So, of course, project quality is key. And also having a project that doesn't have any fatal technical flaws. Moving on, place. Place is absolutely critical. Place becomes more critical the more a project advances through the development timeline. So in the early stages, when it's not real, when it's a dream, and everybody loves a dream, place is less important. But as a project starts to advance, people get very concerned about jurisdiction. So that's jurisdiction risk, that's economic hurdle, what is the existing infrastructure like? If this becomes a development project, what's the timeliness or the pathway to development? So place also is critical. One thing that we don't talk enough about, and this happens not just in the junior sector, but it happens with larger companies, is cost of capital. And this is, what does it cost on an NAV per share basis, and I'm going to touch on this in a moment, so I'm chucking terms at you, is your ability to fund your business. And Neil mentioned this with Robert Friedland, that he has probably the lowest cost of capital in the world for our business, and he probably does, as do other people who've had successes. And so this is your ability to raise money and deploy that money and create value in those two acts. This strategy. Now I'm going to touch on this quite a bit. Strategy is also important, and cost of capital and strategy are intimately linked. Catalysts, I think we all know the obvious catalyst. Catalyst for your share price movement is drill bit. That's why we attract the retail crowd, because this is there's very few other sectors that you can invest in where one piece of information, and that's a drill hole, can result in incredible share price performance, even in a day where you see stocks up 20, 30%, 100%, 1,000% in a few weeks. This is why we keep attracting people back to this sector. But there's also other catalysts that are above and beyond your movement to the underlying commodity price. That might be a named investor, whether it's Rick Rule or whether it's Crescat Capital or anybody else that is seen to have had success. We live in a world where people tend to be sheep-like in their behaviour, and so success begets success, although that's kind of irrational in my opinion, and I'll touch on this in a moment. And then finally, promotion. Now, promotion is, I think, considered to be a dirty word, but when you look around, you're competing against literally thousands of other public companies, in excess of 3,000 public companies, all competing for this finite source of capital that's circling the globe. So how do you stand out? How do you stand out against all of those companies? Now, if you as a leader of a company don't like promoting, are not good at it, or are uncomfortable doing it, make sure that you have someone in your organization that feels those weaknesses, because you have to be able to tell your story, and you have to be able to tell it well, and you have to be able to tell it in a way that resonates with whoever you're pitching your story to. And that's not just investors, that's dealing with the regulatory authorities, that's dealing with local communities. It's about building bridges and relationship bridges in all aspects of the business. Just touching on NAV, net asset value. So simplistically what this is, it's the asset value, and that needs to be defendable, plus cash, minus corporate G&A and debt, and that is your NAV. And so when you're speaking to investors or bankers, they'll throw around this term NAV. And NAV per share is simply whatever your defendable value is divided by your shares. And so when people talk about dilutive versus accretive actions, an action that you take that negatively impacts your NAV per share, so such as financing at a very weak share price, that's dilutive. An action that you take that positively impacts your NAV per share, that's accretive. So on to strategy. Again, this is maybe a little bit of a different way to think about it. Financing considerations must drive your strategy, not the other way around. And the reason is this. If you're a $5 million company or a $10 million company and you have a project that has 100 to 200, 300 to $1 billion capex, that's a mismatch. You'll never be able to execute on that strategy. So you need to have a strategy that makes sense given your access to capital. I think we've all seen the Lassonde curve. Pierre has done a great job of attaching his name to something that I think we all knew and understood, and I'm actually thinking of adjusting this, and I'm going to talk about it and calling it the Adshead-Bell trajectory. So we know that the discovery cycle is where the juice is. And the reason for this is when upside is unknown, everybody assumes upside is limitless. And so the discovery cycle is the best place to be. It's the time when you should raise the most money, because the more you advance your project, the less people care. And we live in a world where we think we need to go from A, we need to have a discovery, we need to have a resource estimate, we need to have an economic study, we need to advance that economic study. In many, many markets, including the one that we're in today, that's value destructive. Nobody cares. All you're doing is spending a great deal of money and negatively impacting your share price. Having said that, This changes in a bull market. In a bull market, people want to see projects advancing. So the only time you should be advancing your project aggressively and the only time you'll be rewarded for that in your share price is in a bull market. And also, as a project goes on, and this is touching back to the place part of how you manage your business, reality becomes more important the more a project advances. So in the discovery phase, all the questions that you'll be getting asked is around the ownership, do you have 100% of it, and geologic quality. As you progress, people start asking about, well, how big can it be? What's the jurisdiction like? What's the permitting timelines? As it progresses further, they're concerned about fiscal, what's the tax, what's the royalties, what's the regulatory environment? And finally, as you start into the build phase, it's very much focused on ESG, CapEx, OpEx, economic hurdle. And this pattern replicates itself time and time again. So I just want to show a recent example, and to me this fits probably advancing your project at the right time, but it's also the people equation. So this is a company that was developing a project in Latin America. They announced that they have got a +2-quarter delay and a +35% increase in CapEx in bad markets. Now you can see their share price response. They were down 70% in a day. They then came out with another announcement that they still haven't reached a financing solution, down another 40%. Basically in a month, this company is down +90%. Now, if I look at that company, my takeaway is that the people did not manage the business effectively. Somewhere something went wrong. So that's either executing on the build, not having the appropriate people, or probably the appropriate people in that particular country. So you don't want to do this, clearly. And this is an example of what the new and improved Lassonde curve looks like, and this company has experienced it. And I would say they're in a near bankrupt situation. So on financing strategies, there's a right way to do it and a wrong way to do it. Now, I wanted to touch on, I'm sure everybody's familiar with ATTAC, and now I'm not attacking ATTAC. It's very, very easy to sit and pass judgment when you're not in the hot seat. And I was an armchair CEO for many years on the buyer side and then actually ran a company, and it's incredibly difficult. Running a junior mining company, it takes grit, it takes blood, it takes sweat, it takes tears. It is a very, very, very difficult job. But I just want to point out a few things. So in the last bull market, ATTAC had a great discovery. Everybody was very, very excited about it. At the peak of its value, without a resource estimate, it had an 800 million market cap because this was the next Nevada. Now, they raised some money at the top. They raised 23 million, but they clearly did not raise enough. And so market turned. They didn't deliver into the upside that everybody thought was there. And then ultimately were acquired for $31 million. So this is what not to do with your financing strategy. If you have had a massive run up in your share price, the market is frothy, people are chucking money at you, you take as much as you can. You don't say no to money coming your way. When the ducks are quacking, you need to feed them. Another recent example, GT Gold. Now, I would say their financing strategy had room for improvement. They never financed near the top, and they financed their first below their initial financing price. Didn't really matter in the end. Everybody made money. They were taken out by Newmont for a reasonable valuation. Moving on to what I would argue is probably the perfect example of how to manage your business, which is Great Bear. These guys absolutely hit it out the park, and I think it should be compulsory reading to understand what they did. So Great Bear, fantastic discovery, and what this red line shows is every price that they financed at. So every time they finance at higher prices. Investors love this. If you want to generate investor love and attention and support, you do this. It's very, very difficult to do, and they did it exceptionally well. Their peak valuation was in excess of $1 billion at the top, never produced a resource estimate, and were taken out. Premium on top of a premium by Kinross. Unfortunately, I was a Kinross shareholder at the time, and the market didn't respond well to Kinross taking them out. But this was perfect execution, absolutely perfect. Now, Kinross recently came out with a resource estimate, and at the time, people were talking about this asset having in excess of 10 million ounces. And when they were acquired, if you speak to the company, they said they had some shareholders calling that being very, very upset. How could you go out right now? There's so much upside. But this is the resource estimate that came out on this deposit. Now, if this company had existed and came out with this resource estimate today, its share price would have been down 50%. So timing is everything, and understanding when to execute on your strategy and particularly when to raise money is key. Looking at another recent example, I think these guys have done a great job. This is Reunion, a fantastic discovery in Guyana. Now, over the last 18 months, they've raised over 106 million, including a $70 million bought deal recently. Now they have started to go into the development cycle. They've produced a resource estimate that hasn't really disappointed, but what they've done, they have a very, very, very hefty balance sheet. So no matter what happens, no matter if gold price goes down $500 in a day, no matter if there's delays in their project, they have a balance sheet that they don't need to come back to the market in the near term. And that's a very, very powerful place to be. Another recent example, of course, a fantastic success story in the Yukon. And with respect to Snowline's financing strategy, I'm clearly not pressing this hard enough. They've raised 49 million in 18 months. I would argue that Snowline hasn't probably been aggressive enough. If I was Snowline, with the interest in this, their asset, incredible share price performance, potential for a world-class discovery, everybody is assuming this is plus 10 million ounces. You've had some pundits saying plus 30 million ounces. There's a lot of expectations that have been built into the evaluation of this company. And again, the perfect time to raise money is when everybody assumes the upside is limitless. And they currently have 36.3 million. And so my advice to Snowline is, if someone is offering you money, take it. Don't say no. Don't worry about the dilution. Another recent example is Chalice, fantastic discovery in Australia. And at their peak, with no resource estimate, it's a PGM plus nickel plus copper, had a plus $3 billion valuation. Now, the mistake that Chalice has made in a weakening commodity price environment is making it real. And so they released their resource estimate, share price went down, and the most recent decline is due to releasing a scoping study that materially disappointed the market. However, they've raised in excess of $230 million in 2 years, and despite their recent share price, calamitous share price performance fall, I'm doing something seriously wrong on this. It's not moving forward. I keep missing my punchlines. No. Oh. It's goblins. Keep going forward. Keep going. Now you can see everything. So the crux of it is, despite their incredible share price decline, they have in excess of $130 million today. So they now have time, and now business having the luxury of time and a balance sheet, so they can try and mend. Some of this calamitous share price decline. Is this thing working?
It's over here, so.
Oh, that might make you right. That's fantastic. Okay, I've been waving it around the room in the wrong direction. And so what Chalice has is a balance sheet. They have a balance sheet to try and wait for better times. They do not have to come back to the markets early. So again, it's about ensuring, ideally, that you have a balance sheet that can survive for 3 years of your business plan. If you can do that, you're doing a very, very good job of managing your business. Just want to touch on messaging a little bit, because this is something that frustrates me. It frustrates me as an investor and frustrates me as a director, is as a company, you control the messaging, so control it. So many companies are very, very guilty of overselling and under-delivering, and that's a very, very bad place to be. Trust is the rarest commodity in our business. If you can engender trust with your investors, whether it's retail or institutional, you'll see material impact in your value. And it's not rocket science. It's do what you say you're going to do. And so if you think you're going to come out with a resource estimate in 6 months, say you're going to come out with it in a year. And if you deliver in under a year, everybody will think you're a genius. And so this impetus that our sector has of pre-selling good news, you see it time and time again. A management team will say, we're drilling, we're excited, et cetera, and then they come out with good results and the share price doesn't react. So be very, very strategic and very disciplined about messaging. And few companies do that very well. And one of the best in the business at doing that is Agnico Eagle. You don't want to negatively surprise your investors, because at the end of the day, a fund manager, as Neil said, getting embarrassed by pitching a story that maybe your PM bought, or as an analyst that publicly said this is the the next greatest thing since sliced bread, that disappointment results in a very, very negative personal reaction on the other side. So I just wanted to touch on something that I was involved in to, again, prove that I'm not just an armchair CEO. And this is the Bravo example. And so how this came about was at the end of 2021, a Brazilian who is very, very well known in Brazil. He's been very, very successful in Brazil, been involved in other companies, got a hold of an asset from Vale and got a hold of it for very, very good prices. Now, this guy wanted to take it public in Canada. He knew me from a different life. I've had spent quite a bit of time in Brazil. He reached out to me and said, Nikki, I have this great project, want to list it in Canada. Do you want to become involved? And from my perspective, it was a chance to put all of these things that I've learned from being on the other side of the table for the last 20 years into practice. So what we did was we secured the project. We talked about how to structure a financing. And so what I brought to the table was an understanding of capital markets and very good relationships with institutional investors. So we started a heavy pre-IPO marketing effort to say who we are, what we were doing, and how we marketed this story is this was a story that an asset that had been drilled by Vale in the early 2000s. It's a very large PGM mineralized system. Hadn't been advanced for 20 years because it's not a commodity mix that Vale was interested in. And so our messaging was this is exploration upside without exploration risk, because Vale only drilled to 150 meters. They didn't do tight drilling. They didn't understand the complexities of the system. So on the people side, Luis brought in me from the capital markets, had someone who was an expert in PGMs, had another person on the board who has built and operated mines in Brazil, and then brought another Canadian on the board who's been involved, very well respected in capital markets. So we hit the people side. Every single person that works for this company on the management side is either Brazilian or lives in Brazil. And so that really, really resonated with investors, local knowledge and the importance of having local knowledge and local expertise. And then on the financing side, we raised at a pretty good valuation, 8 million at 50 cents. And the strategy that we took there was to speak and introduce the company to as many institutional investors as we could. So institutional investors may not be able to invest in private companies, they commonly can't. But what they like and appreciate is having the respect that you come to tell them about the story and don't just come at their expensive round and demand money. So that put us in very good stead. We attracted BlackRock, the largest fund manager in the world. They very, very rarely do private placements. We also tried to position people, I think I might have coined the term, mining influencers. And so in the cheaper round, position those people who are well known, who will talk their book, who can do some of your marketing for you. And so not just papering up a bunch of your mates who are going to sell it on the minute that it IPOs. Then we commenced exploration activity, so had some nice drill results, and we moved towards IPOing in the middle of last year. And now if you remember mid-2022, it was a terrible, terrible time in the markets. So bad that most of our syndicate, which was who's who in Canadian banking, did not think they would be able to get the deal done. And actually, if we'd relied on them, we would not have been able to get the deal done. And so between myself and a couple of the directors, we bought all the orders. And what we said from the very start is we're only doing straight share financing. We are not doing a warrant or half warrant. And I could talk for hours as to the pros and cons of both of those. And we set in people's minds value. We said we're going to go public at plus US $1.50 a share. And so we cemented in everybody's minds the value. We didn't allow the market to dictate the value to us. And it worked. So we went public at a $175 million valuation. We had in excess of $40 million in cash. And so we then had the luxury of having a balance sheet to ride out the volatility that we see in the sector. The company then continued to have great drill results, continued to message very, very well, and then, even though we didn't need money, raised another chunky amount middle of this year at double the IPO price. And so now the company is off to the races. And so if you are going public or you think about how you manage your business, you need to try and be looking 6 months, a year, 2 years ahead, and trying to structure your balance sheet and access to capital to deliver on those strategic goals. And then finally, Buffett said it best: when everybody is fearful, you should be greedy, and when everybody is greedy, you should be fearful. So as a company, when you're feeling really, really happy with yourself, when you're feeling like you've done a great job, you should raise equity. When people are offering you equity, it is never, ever a bad move to say no. And what you see is when your chart is like this, management teams and boards get greedy. They think, oh, but we might go a bit higher. You might, but you also might not. So when people want to give you money, do not say no to it. And on the opposite side of that, when times are bad, when you're feeling very depressed, that's a good time as an investor to be buying, but as a manager of a company, if you have a balance sheet or if you're an operating company, that's the time to buy assets. No one ever does this. I don't understand why. Well, I do because management teams are generally irrational, but that's the time to buy assets or hibernate. There's nothing wrong with not aggressively advancing. It is naive and it is irrational to think that spending money on something that the market does not want to hear about is going to generate value. All it's going to do is weaken your balance sheet and put you in a precarious position. And finally, remember where the shareholder sits. They sit at the bottom of the pile. And what investors want to see is they want to see management and boards thinking like an owner. And one of the reasons for this is very, very few decisions that a company makes require a shareholder vote. So for example, a company can go and burden the project irreparably with a royalty, unattractive royalty or stream on the primary commodity, and shareholders don't get a vote on that. So just always have in the back of your mind as to what a shareholder will react, and ideally your shareholders in your own business. And that's it.
Thank you very much, Nikki. That was invigorating as always. So I'd like to thank you for joining us for this morning's session. We're now taking a network break, which is generously sponsored by SLR. Thank you.